Okay. From the previous video, we end at the equilibrium price in the bond market. In this video, we are looking at the factors that can shift the whole demand or supply in the bond market. The factors that can shift demand in the bond market come from wealth, expected return, which will be changed when the expected interest rate change, risk relative to alternative asset, and the liquidity of the asset. The shift in supply comes from expected profitability or investment opportunity. It reflects how companies see the future economy, expected inflation, and the government budget deficit. Let's take a look on the demand side first. The factor that can shift the demand curve for bond, the first one, wealth. When the economy is growing and the wealth is increasing, quantity of bond demanded at each bond price will increase. That's why you will see the whole shift of the demand curve, shift the whole curve to the right if the economy is expanding. If we are in recession, you can expect to see the demand shift down or shift leftward. The second factor, I think the textbook might say expected return, but I would like to use this term, expected interest rate, because it starts from there. When people think that interest rate would be higher next year than they had originally anticipated, the expected return today on the long-term bond would fall. So, if you remember the coupon bond formula, present value equal to the cash flow in the future discount back by the interest rate, right? If that interest rate change, the price or the present value of this long-term bond will change. When the price of the bond change, the rate of return will also change. The rate of return comes from two parts. The first part is coupon payment per year. The second part comes from the difference in the price. You expect to sell at a higher price in the future, right? And the gap between the expected price and the price you purchase, that rate is called rate of capital gain. That's another source of rate of return. So let's take a look in detail what happened when the expected interest rate change to the rate of return, and then it will link to the demand for bond. Okay, let's take a look at the relationship between expected interest rate and demand for bond. We're talking about demand side on the bond market. Which factor that can shift the demand for bond, right? And expected interest rate is one of that factor. Okay, this is the example that I had from previous chapter. It is showing the relationship between expected interest rate and the rate of capital gain and then rate of return. Okay. First of all, when interest rate in the future change, the price of bond will change. When the price of bond change, it will change the rate of capital gain and then rate of return. The definition of rate of return comes from this one. There are two parts of the return. The first part comes from coupon payment every year. That is called current yield. The second part is from the expected price that you can sell in the future minus the purchase price that you bought it today, PT. The gap between these price is called rate of capital gain. Okay. So let's say if I have one long-term bond, 30 years to maturity, and the initial current yield or coupon payment is 10%. 10% times $1,000, let's say face value is $1,000. Coupon payment per year will be $100 per year, right? The price next year depends on the interest rate that you think it's gonna be next year. So how do we calculate the price next year? First of all, from the coupon bond price formula, we get PV, present value, equal to price, equal to the cash flow in the future, right? Plus, at the end of end year, you're gonna get face value back, but cash flow in the future, you have to discount back using that interest rate that you think it's gonna be. So right now, it's not gonna be 10% anymore. It is 20% because the expected interest rate has changed. Okay, so 1 year from now, what the price will be for this bond? Okay, so you're gonna get $100. This is 1 year from now. You already hold this bond for 1 year, right? So what you have left is 29 years to maturity. You're gonna hold that another 29 years. If you want, you can sell it, right? Next year too. If you want to sell it, what should be the price? This is what we are calculating. $100, another 29 years, because you already have it for 1 year. Face value is $1,000. 29 year. Interest rate here is 0.2, right? How to calculate this? You can use Excel. Type equal sign PV. The first one in parentheses is rate, 0.2. The second one is year to maturity, is 29 year. And then payment per year, coupon payment, $100. Face value is $1,000. Use this formula. And then you will get 502.53. If you look at page 78, you will see this table. But they didn't really tell the detail how they get it. I am telling you the detail. So I'm gonna put $503, which is here. $503, right? Rate of capital gain come from difference in the price. Future price 1 year from now is 503. You bought it at $1,000, over $1,000. That would be, well, I'm using Excel again. It's negative 49.7%, right? The rate of return come from current yield, IC, plus rate of capital gain. That is 10% plus negative 49.7. So the net will be negative 39.7%. That is the rate of return when the interest rate, when the expected interest rate increase from 10% to 20%. Rate of return will drop like this. Price will drop, rate of return will drop later because of the capital loss. When the rate of return drop like this, that means the demand for bond will also drop. $30-year bond drop. Expected interest rate increase, demand for 30-year bond drop. And that is why you see the shift in the bond demand to the left